Let me also welcome in our guest this afternoon, Puru Saxena, who's joining us from Hong Kong. Puru, good to have you with us on ET Now. And on a day when, we're seeing such a crack on the index, leading to all those questions arising once again about really where we're headed at this point. Put it into context for us, Puru, from your standpoint, given the current volatility and uncertainty we're seeing across global markets, how do you see things? How do you see the market specifically in India at this point? Do you feel we're entering a prolonged era of weakness? Do you see more money moving here at all? How are things standing at this point, according to you?
Well, I think we are very, very late in this cycle. We've had a very big bull run in most of the equity markets in the world. And we are now very, very late in this business cycle because if you look at the yield curve, which I monitor very, very closely in the United States and also in some other countries in the world, the yield curve is now inverted in most countries. What that means is that the short-term interest rates are now higher than the long-term interest rates, which is an abnormal condition because normally the short-term interest rates are lower than the long-term interest rates because of the risk premium, because the lenders want a higher rate of interest for a longer period of time because they are taking more risk lending money for, say, 10 years as opposed to 3 months. But what we've seen over the last few months is that we've seen an inverted yield curve, which means that the short-term rates are now higher than the long-term interest rates. And what that means is that the bond market is extremely worried about the lack of inflation, the lack of economic growth. And if you look at also the debt burdens in the developed world and also in China and in some other parts of the world, the debt burdens are very high. And the central banks are now desperately trying to reflate the bubble again. The problem now is that interest rates are already so low that the policy response heading into this downturn is going to be pretty difficult because if you look at the past 5 or 6 cycles, to come out of those recessions, the Federal Reserve in the U.S. cut interest rates on an average of about 550 basis points. And where we are today, we are already close to the zero bound. We are 225 basis points or thereabouts. So it's not going to be very easy for the Fed or any other central bank to provide the policy stimulus by lowering interest rates aggressively because, you are stuck with the zero bound. And even if you cut rates a bit lower, you're not going to go down to -4 or 5% because you're going to destroy the value of the paper money. So I think it's going to be difficult. My personal view, and of course I could be wrong, is that we are now in a topping pattern for most of the equity markets. My own judgment is that, we could have an extended topping period or, we may have one last hurrah in the stock markets in the US and also in Europe lasting several weeks to several months. But my own guess is that the equity markets are going to be lower towards the end of next year because if you look at the past 7 or 8 cycles, as I have studied extensively, is that once you have the yield curve inversion, then the forward 2-year returns for equities are very, very poor. So on average, for example, if you look at the past 6 or 7 cycles in the US over the last 50 years, after the inversion, the S&P 500 index advanced on an average of about 10%. So the S&P peaked about 10 or 11 months after the inversion on average. And then once the bull market ended and then we had the bear market on average ended 28% below the level of inversion. So whatever gains that we might see over the next few weeks to few months are not going to be durable according to my assessment. And I think prices are going to be lower, say 12 to 15 months from now.
In that context, then, Puru, what would be a wise strategy for an investor? Because currently the only asset class that was holding any kind of merit were equities. With that kind of forecast, then, would you suggest a shift towards gold or, what would be the correct strategy at this point?
Well, it's difficult for me to answer that question because that depends pretty much on the person's investment objectives and also their age and risk tolerance and so forth. But if my assessment is correct, and if we indeed are rolling over from a business cycle perspective, not just in India, but also globally, and if we are entering a prolonged downturn, which will probably last 12 to 15 or 18 months, then equity prices are likely to stay under pressure. Some of the defensive stocks might do okay, and that's why we've seen the strength in consumer staples and healthcare and utilities and so forth, especially in the overseas markets. But I think, cash is a good option for the next 6 to 12 months.
Right, Puru, appreciate your time and so glad you could join us.